Welcome to part 3 of Module 1. In part 3, we're going to discuss three major elements. First, we're going to break down the volume profile tool. I'm then going to show you all the elements of the volume profile tool and show you how to use the volume profile tool. We're then going to show you a replay function of the volume profile. That's how you'll be able to see how the volume profile plays out over the course of a day. We're then going to end by talking about a brief discussion over traditional market profiling versus the modern era volume profiling. So let's move into it. Volume Profile Trading Tool. The volume profile provides an objective visual structure to market activity that reflects the embodiment of the actions of all time frames and market participants. Once you have learned to read and interpret the volume profile, it becomes possible to understand and interpret market behavior. What this means is very simple. If you're able to understand volume profile and understand the various patterns that the volume profile will show you, you will be able to understand what the 5 different time frame participants are doing at any given moment. Being able to understand this will put you in an extremely strong position to interpret future direction of prices. Note, volume profiling is made up of 3 elements. The first is price. Price advertises opportunity. It's made up of time. Time regulates each one of these opportunities. And volume. Volume measures the degree of willingness measures the degree of success of each auction. Volume over each price shows willingness or unwillingness of participants to transact at various prices. We'll talk more about this as we go through the volume profiling section. Volume profile metrics. Here is an exhaustive list of the volume profile metrics you can expect to see not just in this module, but across all the modules as we go over this course. Do take note, whilst this list seems quite extensive and confusing, we will start to break them down individually over the next couple of slides. So what are the key identifiable volume profile metrics? The first is the open, the close, the high, and the low. As the name suggests, this is where the market opens on the day, where it closes on the day, the highest price traded on the day, and the lowest price traded on the day. The next key identifiable metric is the daily range. That is the high minus the low. Then we have the initial balance range. This is the first hour of trading within any market. This is usually depicted in traditional European markets as the K and the L TPO. TPO stands for Time Price Opportunity. Again, we will talk about this further in further slides to come. Then we have the cash range. Now the cash range is typically the hour after the initial balance, so it's the second hour of trading in the day. This traditionally gets depicted with an M and an N TPO print. Note, however, that it doesn't have to be an M and an N, it can be any letter. We are just for ease of understanding, we're going to use M and N. We then have the volume value area plus traditional value areas. The volume value area is simply the area of the distribution where 70% of the day's volume is transacted at. In terms of a traditional value area, this is just 70% of the time of the day where the market transacts at. Then, the value area range. This is simply the distance between the high and the low of the value area of the day. We then have single prints. Single prints are merely a single TPO or a single time price opportunity that exists within a daily profile. Again, we will talk more about this down the line, so do not worry too much if you don't understand this at the moment. We are merely just going through the various identifiable metrics within volume profiles. We then have low volume nodes and high volume nodes. Low volume nodes is where little or none or very little volume trades over a period of a day, where high volume nodes is where a high amount of volume is transacted over a day. We then have tails. These can be buying tails or selling tails. Buying tails and selling tails need to be confirmed before it's a tail. The time of the day for a buying or selling tail is quite important, as well as the cause of the tail. Again, we will understand why this is important as we move further along. We then have the POC, also known as the point of control. We have the VPOC, which is the volume point of control. The difference is the point of control takes into account only the time price opportunities, whereas the volume point of control factors in volume. We then have the profile shape. What is the shape of the distribution? Now this can be a number of different shapes, and again we will talk about this extensively down the line. We're merely just identifying what are the key metrics found within a traditional volume profile. And last but not least, the volume. The volume is merely how much or how many contracts are transacted at each price over the course of the day. Let's now move on and break down and have a look at a basic volume profile. Now that we've dealt with each one of the individual metrics, let's see what they look like in a volume profile and where you can find them. As you can see in front of you, we have a traditional volume profile or a distribution. As you can see on the right of this distribution, we have prices. In the middle, we have all sorts of letters. Now, how a volume profile works is every single session is represented by a letter. Now, this session can vary in duration. Traditionally, most traders each letter represents a 30-minute time frame. However, we could use either weekly or monthly or longer term time frames, so it all depends. What we will be teaching you predominantly throughout this course is a day-to-day profile, and therefore each letter represents a 30-minute time frame. Now remember, we said a volume profile, we have price, we have time, and we have volume. As you can see on the right, we have prices. In the middle with the horizontal bars, that is the volume traded at each price. And then we have the individual letters. Let's now look at the individual parts of the volume profile. So first up, we can see the open. The open price is represented with a big O. This is where the trading session begins. The times for the individual markets vary, so do be aware. We then have the close. The close is represented with a star. Now do note again, closes vary depending on which market you trade. This star will be continuously moving throughout the day as the market trades and will only stop once the market officially shuts. The next metric is the high of the day. As you can see, the high is at the TPO or the letter that trades at the highest price of the session. And then the low of the day. The low is the price, the lowest traded price on the day in that session, in that time frame. We then have the range. The daily range is merely the high minus the low. We then have the initial balance range. The initial balance is the first hour of any trading session. Now this depends. Again, in Europe this can be from 7 to 8 a.m. In the US this can be from the overnight session from 11 to 12 p.m. So it all depends on which market you're trading. Do note, depending on which market you're trading, you should know the opening and closing hours, as this will obviously adjust your charts in according to the time frames. So the initial balance is represented with this long blue bar, and that is the first hour of trade, or where the first hour of trade is contained. We then have the cash range. The cash range traditionally is the first hour of trade once the cash begins. Now again, in the European session, the cash trade tends to open an hour after the futures open. In US, this is very different. So again, note the time differences. If you're unsure, you can find out more information on either the CME website, the Eurex website, or the Life website. We then have the volume value area. Now, the volume value area is the point where 70% of the day's volume is transacted. Now, note on this chart, I've colored it in a purple color. This is so it's easily identifiable where 70% of the day's range, or the 70% of the day's volume is transacted, or within which range is that volume transacted. Then we have the single prints. Now, single prints is where there is only a single TPO or a single letter that is represented on the chart. The reason we highlight these single prints is a lot of the time these single prints can tell us a lot about what's going on within the auction process. We will discuss this a little bit further on, but do note single prints can be highly important, and that is why we mention them. We then have the high volume node and the low volume node. A high volume node is where a lot of volume is transacted at one price or a number of prices, which would be called a high volume area. And a low volume node is a single price where there is low volume traded, or a low volume area is a few prices where a low amount of volume is traded. Again, we will talk a lot more about these as we go further down the line, but it's important to know right now that a high volume node is where a high amount of volume is traded at one price, and a low volume node is where a low volume is traded at one price. We then have tails. Now, a tail, as you can see, is also known here as a single print. However, tail tells us something very significant. It tells us where a market auctions very quickly away from a specific area. Now, we do highlight these tails very often in distributions because they're telling us when a market very quickly rejects a certain price. So a tail is nothing more than a few single prints together. And as you can see, we have it at both the low and the high of this volume profile. We then have the POC or the VPOC. The POC stands for point of control, and the VPOC stands for the volume point of control. The major difference between the two is the point of control represents the price of the day that has the most amounted TPOs. TPOs are time price opportunities, and each TPO is a letter. So the price that has the most letters within a distribution is known as the point of control. The volume point of control is extremely similar. The major difference, instead of being the price with the most amount of letters, it's the price with the most amount of volume transacted. We will discuss the difference between the two of them later on, and I will give you some understanding as to why nowadays most traders focus more on the volume point of control instead of just the traditional point of control. So now that we've seen the volume profile as an entire distribution, I'm now going to show you how we can open up the profile and view each single auction within the day's distribution. So what we're going to do is we're just going to split the profile per auction. Again, later on I will show you how you can set up your profiles, how you can manage your profiles, adjust them according to how you want to view them, and utilize them in such a manner that you can get highly effective information out of them. So, note, each TPO time price observation represents a 30-minute auction, with the open price illustrated with an O and the close price where the next TPO opens. So note, what you're seeing here visually is nothing more than the previous distribution, except we've now opened it up to view every single TPO or every single 30-minute TPO that occurred over the course of the session. As you can see, each one begins with an O, and each one closes where the next price letter starts with an O. Now, the reason we have a look at the individual auctions and why they're important is that we are able to see strengths and weaknesses within each auction that takes place over the course of the day. So sometimes a lot of traders will just merely look at their profiles closed up for the entire session, and they miss a lot of information that is happening within each one of the auctions. So it's important to find a balance between opening up the profiles and keeping them closed for shape. Note, viewing the auction process in this manner will illustrate 4 key points. The first is, when either buyer or seller is in control, it can last for a few TPOs. Now, as a rule of thumb, I have a little bit of an expression or a saying. When a market is moving in one direction, it's a lot like a big ship, a big tanker, oil tanker coming into a harbor. Note, it takes a long time for an oil tanker to turn around. just like the markets. The markets very rarely turn around and very aggressively reverse in one direction. So by opening up the profiles, we're able to see the individual auctions taking place. And when a buyer or a seller is in control, it takes quite a long time for it to actually eventually turn around. Knowing this is extremely powerful information because it means that even if we wish to go counter trend, sometimes we just have to be a little bit patient for our trade to play out. The next reason that we want to illustrate it this way around is that we see most of the two-way trade occurring where price is being accepted and the lease trade where price is being rejected. So, by opening it up, we can see where price is being where the market accepts price, where buyers and sellers are happily transacting with one another, and equally, we can see where buyers and sellers are not transacting with one another. In the example we can see here, where we created these two tails with the A print at the bottom and the Y print at the top, we can see with the A print that buyers very quickly rejected lower prices, and at the top we can see sellers very quickly rejected higher prices. So by opening it up, we can visually see this rejection of prices. The next reason we want to split is that we can identify hidden auction tails, as mentioned before. And these auction tails will show us strength from buyers and sellers. And the fourth reason is we can see where price volatility expands and contracts. What do we mean by that? In other words, when we have small small ranges within an auction, as you can see, we have small ranges initially in this auction for the first couple of half-hour bars. And then the market suddenly, when we have the V print, the market suddenly opens up. So we can see a sudden shift in volatility. So opening up the auction process in this way will show us when there's suddenly a shift in the auction that is occurring between buyers and seller. And this sort of information is extremely vital to us as traders when making trading decisions.
Welcome to the Volume Profile Replay series. What we're going to be doing, not just in Module 1, but across most of Module 3, is a lot of replay functionality, whereby we can take various days over the period of any kind of desired period in any market, and we can replay that day type just sped up to a desired speed. Now, there's a whole host of reasons why we utilize the replay functionality, but some of the major advantages why we professional traders use it, and as well as why you should use it, are as follows. So, why do we ultimately use it? First and foremost, we use it as a form of pattern recognition. Now, it's imperative that over a period of the day, you will see the markets tend to move quite a lot, and there's quite a lot of noise over a period of the day. And a lot of the time, when you get stuck in the very short-term time frames, you forget to observe the patterns that the market is actually showing you. So first and foremost, it's a very valuable tool for recognizing various patterns that occur. Secondly, we utilize it as a form of deliberate practice. So by being able to speed up a process, we can practice, we can practice various execution methods, we can practice sitting on trades, and we can practice, various principles that we understand about the volume profile. Then the third reason is for principle training. So by principle, we mean if we, for example, were to see a strategy occurring in the market, a lot of the time we don't execute this strategy and complete the principle 100%. So our execution is not always 100% perfect. So by being able to speed this up and re-watch it and go over that principle a number of times in our head, we're able to practice our principles but also improve our execution of those principles. So those are the major reasons why we utilize the volume profile replay series. Now, let's play this video through, and I will take you through the basic premise and the basic understanding of the volume profile. Now, as you can see, the market opens where the big O letter is. So let's highlight that so you get a very good understanding of the opening price. So the big O there and the big O there, that is where the market has now opened. Now the market you're looking at is the German Bund market, and it is on the 15th of September 2016. Now, as you can see, on the left side, we have got what we call an open auction profile, and on the left, or the open auction volume profile. And on the left side, we've just got a traditional volume profile. Now, the reason we utilize both profiles is very simple. Firstly, the traditional profile. We utilize this mainly for shape. It's important to be able to see the shape of distribution, not just as it's occurring over the period of the day, but also over maybe various days and even weeks and months. So we utilize a closed profile to determine shape and structure. In terms of the open auction volume profile, we utilize this so that we can get a better understanding of not just the evolving auction that's occurring constantly over the period of the day, but also when there's a sudden shift or change in the auctioning between buyers and sellers. Now note, when we can view the market auction rotation by auction rotation, we can see a sudden shift in volatility, and that is predominantly why we actually open up the distribution to view each auction individually. Now, as you can see, just a number of things to point out. Remember, each letter is a TPO, or a time price observation, and in this example that represents 30 minutes. Now bear in mind, whilst we will talk predominantly throughout this course about a profile being 1 day, do keep in mind that a profile can be a number of days, weeks, and even months. But for now, we are going to refer to each profile as 1 day. Now, remember, each one of these TPOs has a high and a low. That is the high of the half-hour auction and the low of the half-hour auction. Where the market opens, that is the open of the auction, and obviously the market is constantly moving over a period of the day, advertising prices up and down, as you can see on the profile. Now, what we're going to do is I'm just going to point out a few of the identifiers that are constantly changing over a period of the day. So first and foremost, keep in mind that the value area is constantly changing over a period of the day, which is represented by this orange area. Then the 50% is constantly moving over the period of the day, and that is this yellow line. We then have the volume point of control, which is the red line, again, which is constantly moving over the period of the day, as well as obviously the high of the day and the low of the day are constantly changing as the market price changes. So those are just a couple of the types of evolving things you would look at when utilizing the replay functionality. Now, let's fast forward this toward the end of the day so we can actually go through all the various aspects that you can find on the volume profile. So now as we get towards the back end of the day, you can see that the market now settles and closes. Now let's go through all the various aspects of the volume profile, and hopefully, after you've done the slide with me, you'll be able to recognize all these various areas and call them out yourself. So we're going to start with a very basic. We're going to pay close attention to the close profile as we list all the various parameters. So first and foremost, we have the high of the day and the low of the day. So you should be able to identify that straight away. The high of the day is up. The high of the day is up around that 163.78, and the low of the day is around the 163.05. We then have our value area high, which is represented with the top of the orange line, and then we have our value area low. Our red line is there now, volume point of control. Our yellow line is our 50% of the day. We then have this wonderful little blue box here, which is our initial balance, or our first hour of trade, given this is the German Bund. We then also have the range of the value area. We then also have the range of the entire day, which is basically high minus low. Some of the other things that we can point out is where the market opens, that's the big O, and where it closes, which is the nice star, or the final print of the day. Now keep in mind some of the other factors that you will, obviously I have identified, but we'll speak about more as we go throughout the rest of Module 1, 2, and 3, is the tail at the low of the day and the tail at the high of the day. Now this is known as a tail or as a single print. Why? Because we have a single TPO or single time price observation. So those are just some of the key identifiers you will learn more about as we go through the rest of Module 1. I hope you've enjoyed this very basic introduction to volume profile and the replay series. Don't hesitate, we will or don't worry too much about it. We will spend a lot of time developing these volume profiles, and more importantly, when we get to Module 3, we'll be talking extensively about trade strategy and how you can utilize the profile series to develop those trades. See you guys again soon, and I hope you've enjoyed this volume profile replay series.
Let's now have that discussion about the traditional value area versus the volume value area. What I'm going to do is I'm going to just briefly explain how the how market profiling originally came about, but then more importantly, I'm going to give you the advantages of using the volume profile instead of the traditional value area that was used back in the days. And I would like you to make up your mind as to what you think is more important. So, briefly, profiling in the beginning, when it was first created as a visual chart, it included the most important pillars of auction theory. These were price, time, and dispersion of trade. The original value area included the dispersion of trade over an area of prices known as the value area. This area shows where 70% of trade has been facilitated. This worked very well in the early days of the profiling tool. However, as volume became more important with the expansion of the markets and market participants, traders wanted to add an additional element being volume. In modern day profiling, we now have a fourth element, and those four will include not just price, time, and dispersion of trade, but also volume. So if you look at a basic distribution, which you have on the chart in front of you, as you can see, the volume area is nothing more than where 70% of trade is facilitated in a distribution. Now, the important thing to understand is not whether it's wrong or right to do one or the other. It's about sticking with one or picking one and then sticking with your methodology. So let's look at some of the advantages of using a volume as a preferred choice for your value area instead of the traditional value area. The first one. Most participants nowadays have converted to using only volume value areas, and I'll explain to you why. First and foremost, using volume value area means we can incorporate all the different time zone sessions into our analysis. Now, what do I mean by that? If you look at some of the key US markets, for instance, the US equity index, the S&P 500 or the NASDAQ, or the US bond market, nowadays they're trading almost 24 hours. So the key question you have to ask yourself, any trade that is done outside of the cash pit session, how important is this trade? That's the question you have to ask yourself. Now, being able to use volume as a guide instead of just traditional value areas, you're able to almost use a relative benchmark because in the low or in the time zone or the time periods when there's no cash session and very little volume, this will be depicted on a chart. However, if there's high volume outside of these cash pit session hours, at least that's telling you there is something genuine going on. So using the volume instead of the traditional will sort of almost allow you to be able to use your charts 24 hours as opposed to just certain sessions. The next benefit, volume shows actual intention of buyers and sellers. As change occurs with price moving, buyers or sellers need to react with volume, hence showing their intent. In other words, we can use volume as a key gauge for the intention of buyers or sellers. What do we mean by that? In other words, as price is changing, buyers and sellers are going to transact various amounts of volume. Now at certain points, certain reference points, we're going to see higher volume. At certain reference points, we're going to see lower volume. By having this additional element, we can make better decisions about what buyers and sellers are actually doing. The next benefit is using volume instead of time as a key determinant for fair value. We have a metric that can be used to make relative comparisons, and that's one of the key highlights, guys. Volume you can compare on a relative basis, whereas time, because it's now markets are pretty much 24 hours, it's not as easy to compare over a 24-hour session, because sometimes you do have big institutions or large players in the market, and then sometimes you have no one in the market. So using time is not the best relative tool when in comparison to volume. Therefore, when talking about the volume value area from this point, or the value area, I will always be referring to the volume value area. I will no longer refer to a traditional value area, as I do not believe this is beneficial in this era of trading going forward. Let's now have a look. I'm going to show you on a distribution how it would look different if I used a volume value area and a traditional value area. What you have in front of you is two profiles. The profile on the left is a profile that incorporates a traditional time value or time-based value area. The profile on the right is a modern day volume value area profile. As you can see, it's the exact same day type in the German Bunds, but what I want to illustrate to you is the main differences that you're going to see if you were to chop and change between the two. And that's why I said it's imperative that you decide for yourself what is the most important route for you to take. For me, I would recommend to anyone to just use volume value areas going forward. And however, the decision is up to you, and there is an argument for both cases. However, I feel the benefits and the logic behind using just time-based value area, using volume-based value area is far more important. So let's have a look at some of the key differences that you can see between the two distributions. It's quite obvious that in the left profile, what we can see is that the value area tends to be towards the lower end of the distribution on the day. And the reason for that is the market spent the first half of the day towards the higher end of prices, but it then sold off after hours. So after 4 p.m. when the cash markets had shut, the market sold off and spent the rest of the evening distributing for 5 hours in the lower end of the profile. Now, the question you have to ask yourself is, just because the market spent a long amount of time in the lower end of the distribution after hours, does that signify buyers and sellers willing to accept that price? That's the question you have to answer. Now, if you look at the distribution on the right, you can see instead of utilizing time to determine the value area, we've used volume to determine value area. So we've said basically where buyers and sellers have agreed to 70% of the day's volume, that will be the value area for the day. So you can see the first major difference. Now, again, note in this instance, the point of control, obviously we would have that in a traditional value area, but in a volume-based value area, we will have a volume point of control. In this example, they are the same. The point of control in the left profile is the point where we had the most time frame TPOs traded, and the volume point of control on the right also happens to be the price where the most volume was traded. It's very unusual to see them both at the same price. It does occur, but it's more likely that they occur at different prices. So again, you need to decide from this day forward, what would you prefer to use? I recommend using the volume point of control constantly so that I have a constant benchmark to lean against. The next thing is obviously the balance of distribution. As we can see, the distribution it looks very similar. However, if you used time to determine where fair value is as opposed to volume, you're going to get a different balance in the distribution. The key points to highlight before we finish, and hopefully you can make your mind up about this, is the follows. Where was price accepted? That's the most important thing to understand. The whole point of using profiles is to determine where is price being accepted, and then secondly, where is price being rejected. If you can answer these two questions, it doesn't really matter whether you use traditional value areas or normal volume-based value areas. The question is, where is the market accepting price and where is the market rejecting price? We're going to conclude part 3 now and talk about 4 basic important principles you're going to see in volume distribution profiling. They are fair value, discount, premium, and exuberant prices. So first and foremost, fair value. Fair value is the point at which buyers and the sellers agree to a certain price. These are price levels that are attracting the greatest volume or trade over various time frames. When fair value is established, it will require a change in fundamentals or perception to move beyond what was deemed fair. By that token, once fair value is established, the market spends time within the price boundaries of fair value. This is the price area in which 70% of all trade, whether that's time or volume, is being accepted. So in essence, what is fair value? It's merely the point where buyers and sellers agree with one another. How do we move out of fair value? Well, it requires a very big shift in perception or fundamentals to move us away from fair value. So by that token, markets spend a long time within fair value. What's the next principle? Discount prices. As the name suggests, a discount price is the price at which a buyer aggressively enters the market in order to capture a price being advertised at a lower price than perceived fair value. Markets will very quickly move away from discounted prices, and often these are depicted with tails or very aggressive buy-side price action. Once a market has determined a certain price as a discount, the price becomes a pivotal area for future reference. In essence, if something's cheap, buyers are going to step in very aggressively to take advantage of it being cheap. Now, what is cheap? Well, it's a matter of perception. So, we don't just assume that any price is cheap. We allow the market to tell us based on its response that there is a discount, and then we respond. Do note, fair value does not equal market value. A lot of people make this mistake. Just because a market is accepting prices doesn't mean that is fair value. Or just because a market accepts something as the market value, it doesn't mean it's fair value, which means we can, for a long time, move up and down away from prices, trying to establish where fair value is. The next principle we're going to discuss is premium. Premium is the prices at which sellers aggressively enter the market in order to capture a price being advertised at a higher price than perceived fair value. Markets will very quickly move away from premium prices, and often these are depicted with tails or very aggressive sell-side price action. Once a market has determined a certain price as premium, the price becomes a pivotal area for future reference. So again, just like discounted prices where buyers enter aggressively to pick up those prices and the advantage, sellers enter when prices enter enter a premium or an area known as premium prices. Now note, the key thing in both discount and premium prices worth mentioning is that the point at which a price is deemed a discount or premium, in the future that price point becomes a key pivot point, and we will discuss this at a later stage when talking about strategy, but this is something you definitely want to watch out. These reference points often act as very good areas for momentum type strategies. The last principle we want to talk about is excess or exuberant prices. When the auction process extends beyond prices of fair value as well as discount and premium prices, we then enter excess prices or exuberant prices. The reasoning behind these prices being advertised stem from the psychology behind buyers and sellers. Volatility and panic can force participants to lose sight of what is fair, and as such, markets can advertise at prices which would under normal circumstances seem illogical. These are deemed excess or exuberant prices. Whilst these prices can often be reversed relatively fast, timing is essential, as markets can remain illogical a lot longer than investors remaining liquid. The key point to note is once a market finds an excess top or bottom, these tend to hold as highs and lows for longer periods as the market begins a process of balancing and stability. So note, when you find a market starts to move well beyond what makes logical sense, It's not that you want to be fighting this. You do not want to stand against this because markets can become very illogical. However, once the market does find a turning point, that is where you want to step in with confidence and go against the trend. Because once that market finds that high or low in exuberant prices, we tend to hold those prices for some months. Two examples you can look at is when oil spiked up to $136 a barrel back in 2008. As noted, if you go look at the chart, you will see how not only was that the top, but we very, very quickly navigated away from those exuberant, crazy prices. The other example to look at is the gold price in 2011. Once we peaked up above $1,900 a barrel, you'll very quickly see how the market very quickly moved away from that top and as such continued downward. This now concludes our traditional versus volume value area discussion.
Welcome to part 3 summary, guys, and I hope you enjoyed a lot of the principles we went over. As you can see now, we're finally getting to sort of utilize the tool a little bit, start to sort of finally understand what volume profiling looks like, and actually we've got a template now on which we can start building our understanding of volume profiling. However, let's just have a little summary. Let's go through some of the principles we've dealt with, and then you can get on to doing your tests and your quizzes and your playbook entry. So where we started off with, we spoke about the volume profiling elements, what makes up a volume profile. So the tool, and we said it consists of the open, the close, the high and the low, the initial balance, the value area high and value area low, and then we spoke about the cash range, and we spoke about the point of control, the volume point of control. We spoke about the tails, single prints, and last but not least, the profile shape. Now, it's very important. We're going to give you quite a few questions that you can go and practice this. But what you need to be able to do before you move on to part 4 and before you begin module 2 and 3, you need to make sure that you can 100% complete any template based on any market and identify every one of these parameters. Now, I'll tell you why, as traders, when you start with the profiling tool, why we spend so much time learning to identify every one of these elements, okay? It's so important if, just by doing a basic, what's the high, low, and the range at the end of the day. So by knowing what the daily range is if you, let's say, for 10 days in a row, realize that your market has got, say, a 50-tick range, all of a sudden, let's say you come in one morning and your market does a 100-tick range, or alternatively, it does, say, 50 ticks in the first hour of trade. So in the first hour, suddenly, you do 50 ticks when the normal average daily range of the last 10 days has been, say, 50, right? Straight away, you're going to recognize that difference, right? That difference, just that little bit of extra understanding can mean the difference between, you making a vital mistake or not, you fading a strong trend or not, you getting out of a good trade or a bad trade or not. So that is why we spend so much time on each one of these variables. Okay, when you get to your playbook, you're going to have a few examples, and so you will be able to practice. But make sure, guys, go into the markets, go utilize, your demo account on your TT profiles, and make sure you're able to do this time and time and time again. What I will say, you will get quicker at it. You will learn to quickly identify all the volume profiling elements. So that's where we started off in part 3. We then moved on and we started to talk about splitting your profile per auction. Now, this is crucial, and I'll explain to you why we split it. Remember, obviously, most of what we've done in part 3 is very basic, profiling tool. But what you will start to see as we get on towards module 2 and 3 is you can develop very unique, specific strategies just based on the individual rotations or auctions within the volume profile. So, just to remind you, what is the split? Well, instead of having, for instance, one big distribution as we look at it, that big distribution is made up of lots of different half an hour distributions.
Okay, so instead of looking at it as one big picture, we open it up so that we can see what each one of these distributions looks like. Now, some of the reasons, or the reasons why this is particularly powerful, is firstly control. Okay, so by opening it up, we can very quickly determine who's in control. If I had a look at this example in the up move, we can see very clearly that buyers are in control. So if we're going to be utilizing, say, a specific strategy where we want to fade, we must recognize that we're fading against the buyers who are in control. Okay, so that's the first reason why we tend to split our auctions. We then spoke about hidden tails. So a lot of the time, a traditional tail, as we spoke, you would find at the extremes of the market, at the high or the low. However, sometimes within a distribution, you can see a hidden tail, or a very, an area where a market very quickly navigates away from an area. Now, we will talk more about hidden tails within the profile as we move on towards Module 2 and 3. The third reason why we want to split is we can see volatility expanding or contracting. What do I mean by that? So within our basic example here again, let's say the market goes up in this sort of a fashion. Now note, we can see these are relatively small candles, and they are relatively, or they are contained well within the previous candle's range. So we can see that's contained in that range, that in that range, that in that range, that in that range. Now, if all of a sudden the market, the next candle did something like that and overlapped all 5 of the previous candles, we can see the volatility expanding. So it went from contracting to suddenly expanding. Now, just knowing that, again, we can develop some very key strategies around this contraction of volatility and expansion of volatility. And then we spoke about price being accepted. So a lot of the time, we can see the auctions doing this and then coming back, and then doing this and then coming back. And by the time 4 p.m. hits, you look at it and you say to yourself, well, it was a relatively balanced day where the market spent, the day sort of auctioning up and down and up and down. You don't want to be recognizing that at 4 p.m. You want to recognize that earlier in the day, so you're not spending the day buying highs and selling lows when there's a lack of momentum or a lack of initiation at the extremes. And then the last one we spoke about was sort of the overlapping versus one time framing type distribution. Again, another type control factor. So that is why we split the profiles per auction. Do note we will develop some very key strategies by just opening up the profiles as we go along in Module 2 and 3. Then we spoke about traditional value areas versus I like to call them the modern day volume value areas. Okay, we went through a few of the advantages. Now I'm just going to go through those advantages briefly. Note, when we use volume value areas, we can include all time zones. Okay, don't forget, guys, volume effectively shows trade being facilitated. In other words, at a certain price, we're going to see varying volume. Sometimes the market will, take a lot of volume at a certain price, and sometimes it'll take very little volume at a certain price. And it's this lack of volume or acceptance of volume that tells us how trade is being facilitated at the advertised prices. So that's why we also use the volume value area. And then obviously we said that the most important is that when we utilize volume instead of time, as our key sort of, one of our key pillars in the profile, we can effectively do a relative analysis. All right, it's very difficult if you're utilizing volume values. It's very difficult to create a relative approach. Whereas because you're using volume, you can create a relative approach far easier. So that was some of the reasons why we utilized the volume value areas instead of the traditional value areas. We then finished off, part 3, and we spoke about our key 3 proponents of the profile, and we said they include fair value, they include premium, discount, and last but not least, excess. Now, again, I'm sure most of you understand this, but the best way to explain it is with a volume profile. Okay, so here we have just a typical normal distribution, and as you can see, the market spends most of its time within the middle of that distribution. Now that middle section is what we would like to call fair value, and fair value is nothing more than where the market accepts price. Buyers and sellers are accepting this area as the fairest price based on all available information. When prices are quickly rejected from the high, we like to call that premium. Where they're quickly rejected from the low, we like to call that discount. And the reason we call this discount and premium is because when price is advertised at a certain location, whether it's at the low or the high, because, for instance, sellers feel this is a very high price, they step in to take advantage of that advertised price, and they very quickly sell the market back down in hope of buying it back lower. As a result, we have a premium price, and we have vice versa, the discount prices at the low. An excess price then is where a market tends to move very quickly away from what is even deemed fair value. So let's say, for instance, this is our fair value over a long period of time, and all of a sudden a market starts to lose its head and go absolutely crazy and stop accepting any kind of fair value, and we get this excess, we get this markets lost the plot, and we start to trade beyond prices that are regarded as a premium. When we do go beyond a point where the markets become a bit illogical, we start to talk about excess. The important thing to understand about excess is that it's not so much you want to be selling this on the way up, but what you want to note is that when a market finds an excess point, when it finally does turn around, right, the pullback provides a very good opportunity. Why? Because we know that excess highs and excess lows tend to cap and support the market for a longer period of time. So we know once that market finally sort of finds itself and stops being illogical, once it turns over, we can sell that market for quite a few time periods and take advantage of excess highs and lows. Alright guys, that's a wrap up of part 3. So again, go and test yourself now, go through those concept checkers, make sure you update your playbook, keep working on that playbook, keep working on those templates and building your volume profiles. Good luck, and I'll see you in part 4.
Congratulations on completing part 3. Let's now check some of the concepts to ensure you've understood them. Firstly, what are the 4 elements that make up the volume profile? What are the major benefits to using volume profiles instead of a traditional time-based profile? And explain what discount, premium, fair value, and exuberance is in terms of volume profiling. Good luck. Now that you've completed your concept checker, let's turn our attention to the playbook. In this entry of the playbook, what we're going to do is we're going to actually start using examples from the market and getting you to take a template which we've created specifically for you, and I want you to complete that template based on the various elements that make up the volume profile. Make sure you spend quite a bit of time doing this, and don't rush through this, because getting this correct is going to help you a lot when we complete not just module 1 but 2 and 3. This playbook entry will make up the basic understanding of volume profiles and how to use the tool being volume profile. So, using the profiles provided in the template, complete the basic profile elements. Good luck.